Why do most investors lose money? It's simple. They risk too much for too little. But the investing legends, they play a different game. Their secret weapon is a strategy called asymmetric risk/reward, and it's been the key to their phenomenal success. I'll show you what to steer clear of and reveal how you can apply this powerful strategy. By the end of this, you will never look at investing the same way again. First of all, what do you need to avoid? Have you ever had someone come to you and tell you to buy X because it will most likely go up 20% in a few months? For me, that someone was my dad. Most recently, he told me to buy about 300 shares of Intel for $30 per share and sell them shortly after for $36 a share. We were risking $1 for a chance to make 20 cents. This is a common behavior among investors. They risk a lot to make a little. As a result, one wrong bet can erase the profits of 5 correct bets. On the other hand, the investing legends do the exact opposite. They use a strategy called asymmetric risk/reward, which means they risk a little to make a lot. Paul Tudor Jones, one of the most famous traders of all time, would always try to risk $1 to make $5. He's not like my dad, who tries to risk $1 to make 20 cents. Richard Branson, a billionaire business titan, would always ask, what's the downside to this deal, and how can I not lose? When he invested in Virgin Airlines, the planes were the biggest risk. So he negotiated a deal with Boeing. If the business fails, he could return the planes. Unlike the typical investor, these legends are obsessed with not losing money. Warren Buffett always says he has 2 rules for investing. Rule 1, don't lose money. Rule 2, see Rule 1. Why the obsession? If you lose 50% of your money, you need a full 100% to get you back to where you started. Ouch. How do they put this asymmetric risk/reward strategy into practice? They anticipate and diversify. When they're investing, they usually can't get all of the information required to make a decision, so they must anticipate failure and plan for the worst by diversifying. They want to limit the chances of large losses which come from extreme and unpredictable events. To diversify, you can invest in things with low or negative correlation. Low or negative correlation means that the price of one thing usually doesn't affect the other. You can look for opportunities worldwide rather than focusing on just one country, since countries do not share the exact same economic cycles. Investing globally has become a lot easier with things like international exchange traded funds, ETFs. Another method you have is use options to limit your downside. An option is a type of investment that limits your maximum losses to how much you pay for it, that is, the fees. For a small cost, you can buy a call option that gives you the right to buy something at a locked-in price in the future. However, options have expiry dates. Let's say Apple is selling for $50 per share and you expect the price to go up, but you're not 100% sure. What can you do? Instead of buying the stock directly, you can buy a call option on it to lock in the price of $50 per share by paying a small fee of $5. Why would you buy an option instead of the actual stock? If you buy the stock directly, you can lose up to $50 per share. If you buy the option, you can lose up to $5 per share. If Apple drops to $10 per share, you can choose not to use your option and you will only lose $5 per share, or the fee you pay for the option. However, if you didn't buy the call option and just bought the stock directly, you would have lost $40 per share. What if Apple goes to $80 per share before your option expires? You can use your option and make a profit of $25 per share. In short, your downside is only the cost that you pay for the option. Your upside is how much your stock goes up minus the predetermined stock price and the option's cost. Another choice is using a fixed index annuity. This investment combines the best of both worlds. Not only do you benefit from market gains, but you are also protected from market crashes. Additionally, it can give you an income for life, so you can have a stress-free retirement. If you don't know what FIA is, you're missing out. This next video will show you how you can take advantage of it. If you're not subscribed already, make sure to subscribe.